Gold is up nearly 10% in a single month. That is not a typo. As of today, August 13, 2026, gold spot price is sitting at $4,437.30 an ounce, and two genuinely respected voices in this space completely disagree about what happens next. One says this is the beginning of something historic. The other says you are walking into a trap. Here is both sides in full, and you decide. Let me set the table first, because the data here matters. Gold has moved from roughly $4,038 just a few weeks ago to $4,437.30 today. That is a gain of nearly $400 an ounce in under 30 days. The federal funds rate right now is 3.63%, US CPI sits at 332.813, and real GDP growth has slowed to just 1.5%. That macro cocktail is exactly the backdrop where this debate gets interesting. A lot of you have been asking where gold goes by the end of 2026, whether we hit $5,000, or whether we pull back hard. That is precisely what the two sides disagree on. Let's hear both of them out. Expert A, the bull case. Call this voice the structural shift camp. Their argument starts with something most mainstream commentators are still missing. This is not a simple inflation trade anymore. Central banks globally bought over 1,000 tons of gold for the third consecutive year in 2025, a pace of accumulation not seen in 5 decades. The structural shift camp says that is not a coincidence. That is de-dollarization in motion, meaning countries are quietly reducing their reliance on US dollar reserves and replacing them with gold. When sovereign buyers are absorbing supply at that rate, the usual rules about gold being just an inflation hedge break down. You are not trading a commodity, they argue. You are watching a quiet rewriting of the global reserve asset system. Their second argument is the real rate picture. Real rates, meaning the Fed funds rate minus actual inflation, are still barely positive or effectively zero depending on which inflation measure you use. At 3.63% Fed funds against a CPI index of 332.813, which implies ongoing price pressure, the incentive to hold cash instead of gold is far weaker than the Fed wants you to believe. Historically, gold has performed strongly when real rates are below 1%, and the structural shift camp argues we are functionally still in that zone. Their third data point is momentum and positioning. Gold is up nearly 10% month over month heading into a PPI report, meaning the Producer Price Index, which measures inflation at the wholesale level. If that number comes in hot, the structural shift camp says the next leg higher begins immediately. They point to the fact that Western retail investors are still largely underexposed to gold, with gold representing less than 0.5% of global financial assets. If even a small reallocation happens, the demand surge could be enormous. For you as an investor, their practical implication is clear. A 5% to 10% allocation in physical gold or a gold ETF right now is not speculation in their view. It is basic portfolio insurance at a moment of genuine systemic stress. Now expert B, the bear case. Call this voice the mean reversion camp, and do not dismiss them, because their arguments are grounded and serious. Their first point is that a 10% move in 30 days on an asset with no yield is a warning sign, not a green light. Gold at $4,437.30 an ounce is already pricing in a significant amount of bad news. The mean reversion camp points out that every major gold spike in history has been followed by a consolidation or correction of 15% to 30%. After gold peaked near $1,900 in 2011, it fell all the way to $1,050 over the following 4 years. That is a 44% drawdown. If you are buying at all-time highs chasing a parabolic move, they say you need to price in that kind of downside risk seriously. Their second argument is macro reversal risk. GDP growth at 1.5% is slow, but it has not collapsed. The Fed has not cut rates aggressively. At 3.63%, rates are still meaningfully restrictive, and if the PPI report comes in cool, meaning wholesale prices are softening, the inflation narrative that is driving gold right now could unwind fast. The mean reversion camp also notes that the US dollar has shown resilience at moments when everyone expected it to break, and a dollar recovery historically correlates with gold weakness. The practical implication they draw is that if you are already holding gold, maybe now is the time to take some profit rather than add more exposure at a price that has run nearly 10% in under a month. Their third point is the paper gold problem. And this one is genuinely fascinating. The mean reversion camp actually agrees that physical gold has fundamental value. What they are warning about is that a large portion of gold market trading happens through futures contracts, ETFs, and derivatives, not physical metal. Some estimates suggest the ratio of paper gold to physical gold in the market is somewhere between 100 to 1 and 200 to 1, meaning for every 1 ounce of real gold, there may be 100 to 200 paper claims on it. In a normal market that is fine. In a stress event, it is not. If a large wave of traders tries to take physical delivery at once, the mechanics break down. The mean reversion camp says this is a structural fragility that could cause a sharp, violent correction even while the long-term fundamental case for gold remains intact. For investors, their practical advice is, if you are going to hold gold, hold actual physical metal or allocated storage, not a paper proxy, and do not size the position so large that a 20% to 30% drawdown would force you to sell at the worst moment. So where does that leave us, and where do I personally land? I will be honest with you. I think both sides are describing real and legitimate risks simultaneously, which is actually the most useful thing this debate reveals. The structural shift camp is right that something foundational has changed. 1,000 tons a year of central bank buying for 3 consecutive years is not noise. De-dollarization is not a fringe theory anymore, it is a documented policy trend across dozens of sovereign nations. And with real GDP at only 1.5%, the macro environment is not one where you want zero exposure to hard assets. But the mean reversion camp is also right that buying after a nearly 10% monthly spike at $4,437.30 without acknowledging drawdown risk is not investing, it is hoping. The paper gold fragility point is one I take seriously, and if I were building a position today, I would prioritize allocated physical over an unallocated ETF. My personal lean is that gold is in a structural bull market that is not over, but the next 30 to 60 days could be choppy depending on the PPI number and whether the Fed signals anything new. I am not calling $5,000 by year-end as a certainty, but I also would not be surprised if we get there. The question I keep asking myself is not where the price goes, but whether the structural reasons to own it are still intact. And right now, they are. What I want to know is what you think. Drop your honest read in the comments below. Do you side with the structural shift camp, or the mean reversion camp? And if you want more videos where we lay out both sides of a macro debate with real data, no hype, and a straight answer at the end, subscribe to this channel. Most financial channels give you one side and call it analysis. We go deeper every week into gold, precious metals, and the macro forces that actually move markets. If you want research-heavy breakdowns that treat you like someone who can handle the real complexity, hit subscribe and we will see you in the next one. Quick note before you go, I am not a financial advisor, just someone who genuinely geeks out over this stuff and shares what I find. Nothing here is personalized advice for your situation. But here is the thing most disclaimers leave out. The people who do their own digging before making a move almost always make better decisions than the ones who do not. So do your own research, know your own risk tolerance, and treat everything you hear, including this, as a starting point, not a finish line.